Mark, good evening. How are you?
Good evening. So welcome to the Financial Freedom Through Apartment Investing. I am your host, Mark Caesar, and we are a proud affiliate of the GOB network of apartment investors, where we educate, we empower, and we connect people to wealth. So today we have none other than Mr. Bill Ham. As I'm pretty sure you guys are very familiar with the name, Bill is the author, the #1 Amazon bestselling author of Creative Cash, the complete guide to master lease option and seller financing for real estate, for investing in real estate. In his book, he provides an in-depth approach to using creative financing techniques and shares stories of how he closed on his first 400 units without working with a bank or qualifying for a loan. Outside of being a published author, Bill is also the chief operating officer at Broadwell Property Group, the owner and operator of Phoenix Residential Group and Phoenix Residential Management, and a deal expert coach for Jake and Gino. And over his 15 years of experience working with these great companies, he has created a portfolio of over 1,000 units while growing Phoenix Management to a team of 15 staff members. He has taught real estate for the past 6 years and has dozens of highly successful students. Bill uses his extensive real estate experience to teach his students the real side of real estate. Bill, welcome to the platform, sir. We are grateful to have you on today.
Yeah, appreciate it. Thanks a lot. Thanks for having me.
Yeah, so creative financing it's a highly sought out topic. Everyone is talking about it and want to learn more about it. And again, you are a household name that is tied to creative finance.
Not get carried away, but I appreciate it. Yeah. Well, I wrote that book and I appreciate the introduction. I did my first 400 units without using a bank, without going in and qualifying for traditional financing. I did refinance a lot of that real estate into bank loans, but the initial purchase was a lot of creativity done back through 2008, 2010, kind of up through 2012. And the reason that I brought that book, Creative Financing or Creative Cash, out at this point in time is because we're going into another market cycle that there will be a lot of similarities to 2008. I don't think we're going into a giant crash or anything like that. So let me be clear. I'm not suggesting some massive, financial meltdown. I'm not saying that. But there are different market cycles, and the market cycles always come about every 10 years. And if you kind of study real estate and you study different market cycles, you can see a lot of the sort of markers. And so I saw us going into another market cycle that was similar to the one that I went through back then. And that's why I brought out the book Creative Cash, because creative financing is something that we're going to start seeing a lot more of going forward. And that's why all of a sudden it's a hot topic. It's not by chance that this is a hot topic at the moment. It's not by chance that I brought that book out. It's a market cycle. And so everyone that is starting to catch this point of view is getting in line with an upcoming market cycle. It's all about debt. When debt tightens up, that's when the market shifts. So all you have to do is watch your lenders and watch debt. And it seems like debt has been lenient lately, but it's not actually true. Only a certain amount of debt has been lenient. Agency debt has not been so lenient. So yeah, we're going to see a lot of creative financing coming up in the next, I'm saying year to 3 years is going to be the window for creative financing.
Wow, well said. So what, for those who are not accustomed to creative financing, what exactly is it? Like,
yeah, kind of a general term. I mean, there are lots of different things we can do with creative financing. Things that I have done: master lease options, seller financing, credit cards. Again, I don't recommend that one, but creative partnerships, getting a partner to carry back loans or to carry equity, getting realtors to carry their commissions back in IOUs. I mean, you name it. So it's an umbrella concept, meaning to get a deal done without using traditional go to the bank, put down 20%, get a loan type financing. And then so there's lots of different techniques. Yeah.
So so how did you use with your portfolio? You purchased a 400 unit apartment building, which I'm sure a lot of us.
It was not one building.
Oh, multiple.
It was a collection, right? Yeah. So it was
understood.
Yeah, probably 30 or 40 houses, let's see, a 9-unit, a 20-unit, a 27-unit, 152, and 108, and I think there were probably a few other ones in there. I don't know what that adds up to, but roughly up like that. So not one deal, not one transaction. I started off in houses. My very first deal was a duplex, and I did houses for about 3 years. So, pretty humble beginnings, nothing particularly fancy, nothing interesting. I didn't start off in commercial real estate or apartments or any of that. I started off in Macon, Georgia, buying and flipping houses, just like everybody else. So, everyone here can do exactly what I'm talking about doing. So I did not have any super special beginnings.
Understood. So what is this was the structure? What is can you give an example of the structure how you structured that deal for the 400 units?
Yeah, well, again, it was a bunch of different deals, not one deals, lots of different ones. Some of them were master lease options, some were seller financing. So it was all really dependent on the deal. So I think what I would tell people, I think is a better answer, is use what I call the SPY technique. All right. And that's something that I've copyrighted, and it's called SPY, and it stands for it's seller property U, SPY. Right. And so that is the way in which you want to analyze deals, seller property U. So that's how you basically are going to structure creative financing. So sit down and stop when you're looking at the deal and say, what does the seller want? What motivates the seller? What does the seller need? Okay, next we're going to sit down and look at the property. What does the property need? Is it deferred maintenance? Does it need repairs? Like, what's going on there? And then lastly, we stop and think about, what do we need? Is this right for us? And if you'll kind of use that technique right there, you'll increase your probability of using a creative financing in some manner tenfold, because most people stop and think, what do I need? Like, is this right for me? Is this a good fit for me? They think about the property. Okay, it's deferred maintenance, needs some repairs. And then lastly, they think, oh yeah, the seller. And you got to go the opposite direction. You got to think about the seller first. So that's how I would structure any kind of creative financing, is really figure out, what does the seller need? Does my offer fit that seller and their needs? Next, does my offer solve whatever problem on the property? Again, maintenance, whatever the case. And then lastly, okay, does this help me get the deal done in a manner that I need? So if you'll structure deals like that using the SPY technique, you'll get results infinitely higher than you may be right now.
Awesome. So now I know you use a lot of master lease options and seller financing. Can you give us a high level view of both of those?
Yeah, sure.
Aspects?
Seller financing is easy. I'll jump on that one first. That's easy. That's exactly what it sounds like. It's where the seller is acting as the bank. All right. So the seller is going to finance the deal for you, instead of you going over to a bank, borrowing the money from the bank, putting down 20-25%. And giving the seller all that cash at closing. So the seller is going to carry a mortgage against their own property, right? So they're going to finance their own property. Now, the catch with seller financing is the seller has to have 100% equity. So if the seller already has a mortgage with the lender, you really can't do seller financing. Now, people do stuff we call like a wrap or subject to financing. That's different. That's not proper seller financing. Real seller financing means that seller's acting as the lien holder, therefore they can't have a mortgage. They have to have 100% equity. But if they do, then it's just like a bank giving you a loan. The seller is going to transfer the title to you, so you're the new owner, and they're going to carry a mortgage against that property. If you don't pay them, then obviously they would foreclose. So pretty straightforward there. A master lease option, master lease option is a rent to own scenario. So a master lease option is a rent to own scenario where you are going to set the price today for a property with the right to buy it someday in the future. So Mark, let's say you and I have a deal. You have a deal and you want to sell it. And for some reason, I don't think the property is worth what you want. Let's just say you want $1 million for your property. And I say, Mark, I don't know that property is really worth $1 million. But I tell you what, it might be worth $1 million someday in the future. So let's you and I agree on the price of $1 million today. And what you're going to do is you're going to let me rent your property, right? And I'm going to then become the landlord, the operator. I'm going to get to be the management. I'm going to control the cash flow. I'm going to control management, all the operations through this rental agreement. But we're also going to agree on a price. $1 million. And now we're going to agree on a time frame in which I have to buy the property for $1 million. Let's just say 3 years. So I'm going to rent your property for the next 3 years, and nobody else can buy it but me for the next 3 years for $1 million. Now, the idea here is that you find something that is somewhat distressed or has some sort of value add. So I'm going to rent your property. I'm going to go in and do whatever it was you couldn't do, whether it's take care of the maintenance, maybe there's deferred maintenance, maybe the units need to be renovated, maybe we need to raise the rents, maybe we need better management, whatever the case. So I'm going to come in and take over and implement the value add, get the property value above the $1 million. And now I have the right to buy the property at $1 million between now and the next 3 years. And so, the idea is to try and go in there and rent a property that is a headache to an owner. And you'd be surprised how many owners out there would give you their real estate right now to be done with it, to just be over the headache of dealing with it, the tenants, and they don't want to mess with it anymore. Maybe they inherited the property. Maybe they never meant to be landlords. There's a myriad of reasons why sellers do this. And if you're the solution to their problem, if you learn to come in and solve that problem for that seller, again, seller property you, then you can negotiate these kinds of terms where you rent the property, take it over, make the seller's headache go away, and you get access to real estate, and then hopefully you push the value up, purchase it in the future. So that's a real kind of high level view of seller financing and lease options, and sort of what they're used for.
Awesome. So being that this is an AMA style, we're going to open the floor so people who have questions, feel free to unmute yourself and shoot your questions at Bill.
Yeah, very cool. Yeah, anybody got anything here? I've been doing this for a long time. It works really well in different market cycles, and I believe we're coming up on a market cycle where this stuff's going to be very valuable going forward. Good techniques to use. Are people just going to jump in, Mark? Are they going to raise their hand? Oh, we got somebody. Go ahead.
Hey, what's going on, Bill? Question for you on this one. Is there a particular size that these types of deals work for? When just think about like multifamily, right?
Right.
Is there a particular size, 10 to 100 units, something smaller?
In any size, it really has no difference on size at all. It has nothing to do with it. It's really the motivation of that seller. I have done these techniques all the way from small properties up to the largest master lease option I did was on a 108 unit. And the largest seller financing I ever did was a 152 unit. So they can be in the smallest I think ever did was a house. So they can be done on all size properties. It has nothing to do with that. It's really a function of finding a seller that has a problem, figuring out a way to create an offer that is the solution to their problem and the solution to your problem, which is getting a hold of some real estate and for as little money out of your pocket as possible. So yeah, it really doesn't have anything to do with size.
I was wondering if you try to position it as well. You really need to find that value add piece, right? And then you can maybe structure it that you're hey, look, I can pay you more. I can give you a little bit more if you take on the seller financing, knowing that if you can just get time to execute the business plan, you can hit that value add and get that increased valuation, right?
Exactly. And that's my point. That's kind of the point of seller financing and creative financing or lease options, is to just give yourself some time. Perhaps this property would be worth, more in the future if you could do X today, or if somehow you could take possession. It would be worth more if I could raise the rents, if I could renovate the units, if I could just get the occupancy up. That's what this is for, where a seller has an asset that for some reason they themselves didn't perform, didn't get that property doing whatever it should do. And if you could just borrow it for just a minute, you could go in there and do these things and get it. That's the basic concept of creative financing, is finding someone who is over it, for whatever reason, they've gotten in over their head, they're done with it, they don't want to mess with it anymore, and they're willing to give someone a shot to come along and solve their headache. And that's where you pick up things like lease options and seller financing. And that's how I built my first portfolio, was just finding sellers that were burned out or had problems, or the lenders had tightened up and weren't really lending as much on distressed assets. And so that's how I was able to get a lot of the deals that I got my portfolio started with and launched my career with.
So Bill, I've got a question. This is Jim. Most people that have tried to do this, whether on a single family or multifamily, have found that it's hard to find these sellers. It's hard to find these deals. And quite frankly, it's a very, very small percentage of deals that get done this way. So I guess I think what might be very helpful for anyone that wants to try this is to get some tips on what you look for in a property that you think might have a possibility, and how do you identify that? Because most sellers want to kind of play it close to the vest and don't want to share a lot of information with you.
Yeah, absolutely. And to your point, these techniques have not worked very well over the last 5 years. They haven't. And they don't necessarily work great today. I'm not gonna lie to you and tell you they do. They're going to work much, much more over the next 1 to 3 years. They have not worked great over the last 5 years because the more options a seller has, they're good. They don't need this creativity. They don't need to do seller financing. They don't need to do a lease option. When the market is rising as fast as it is, and a seller who's made a mistake can just take the property, put it on the market, sell it, and make profit, even though they didn't really operate it very well. And so that's why we've not seen these techniques working that much over the last few years, but you're going to over the next upcoming years, because, and to answer the second part of your question, things to look for, because debt is going to tighten up. And one of the big areas that lenders are going to retreat from or are going to have a hard time with are aging buildings. So buildings that have high level capital expense needs. So stuff that was built in the 1960s, the 1970s, the plumbing may be bad. There's a lot of wood rot and the building is just aging. Those lenders are going to really start making people escrow a lot more money to get those deals done. And so when that happens, number one, number two, when interest rates go up, and number three, when people that have gone out and gotten short-term mortgages over the last 3 years, they went out and they got 2-year interest-only bridge loans. When all of that comes together, their bridge loans start coming due, interest rates go up a little bit, and these buildings start to really show some wear and tear, that's the perfect storm for creative financing. So those are the things you want to start looking for, is look for a seller that has a problem that is not a you problem that's going to be an everybody problem. All right. So for example, when you're looking at creative, or when you're looking at commercial real estate, you have to pay attention to what's called the debt service coverage ratio, DSCR. Real simple. It's the net operating income, which by the way is just your income minus your expenses. That equals your net operating income. Your net operating income needs to be at a ratio to your loan payment at about a 1.25 ratio. So if we are at a 1.0 net operating or debt service ratio, that means every dollar that we have in NOI equals $1 of debt service payments. We're break even. And what I'm seeing right now in a lot of deals is that the debt service ratio is falling below 1.2, 1.1, 1.0 because of the asking price. And that means that individual is going to have a hard time selling that property to you if you want to go get a loan from a bank. Because when you go into the bank's going to say, hey, that property is below 1.2, 1.25 debt service ratio. And what the bank is going to do is they're going to say, no problem, we'll still do the deal. We're just going to lower your loan to value. And now instead of getting, 20% down payment, 25% down payment, now you're looking at 30, 35%, 40% down payment if you want to pay that price. And that's all of a sudden not going to work. You're putting down 40% down payment on that deal with that cash flow. It just doesn't work, and the numbers don't work. And you just don't want to buy that property. And now that seller needs to sell and you want to buy, but the number doesn't work and everything doesn't work. That's when creative financing comes in. So start watching deals where a seller is asking a price that pushes the debt service coverage ratio below about a 1.25. That's a seller that may become a motivated seller when their mortgage comes due. So that's one of the big things I'm telling everybody right now is look for sellers who have mortgages coming due in the next 2 years. especially if the interest rates go up. Those are going to be people that you're going to really want to talk to about doing some seller financing, creative financing going forward. Hope that answers your question.
You find out what sellers have mortgages coming due.
Yeah, that's a little tough. One, if you have an expensive software like CoStar and things like that will tell you. That is tough. So what you want to do, and let me kind of continue. I guess continue answering the gentleman's question there. How do we find deals to do creative financing on? How do we go out and find deals to do lease options, and how do we find sellers that have mortgages coming due? How do we find these things? And the answer is you don't. You don't. You just look at deals the same way you always look at deals. However you're getting your deal flow, whether it's realtors, whether you're sending postcards, you're direct to owners, however you're getting deal flow, you just keep looking at deals. When you see a deal that doesn't work for traditional financing for whatever reason, instead of throwing it in the trash and saying, hey, that deal doesn't work, I'm saying, hold on, pull it back out of the trash, and let's just apply a couple of creative financing techniques. If they still don't work, okay, then move on. So creative financing is it's really just meant to increase your probability of close. Like the gentleman just noticed, the majority of these deals are not going to work. Right, so these are just extra tools in the toolbox that will increase probability of close. But you all need to be looking at deals the same way you always look at deals, and just use these techniques when, for whatever reason, you can't go out and get a loan. But yeah, you don't want to go around just searching for creative financing deals. If you start calling up realtors and say, hey, do you have any deals with seller financing or lease options and things like that, you're going to come off as you don't have any money and you're not credible and you can't close. So that's why I kind of would recommend you don't go around technically looking for these kinds of deals. Just know these techniques and when to apply them. That's the trick. Does that make sense?
Yeah, that makes sense. Unfortunately.
Yeah, agreed. I know it is not a silver bullet. It is not a magic, this solves all your real estate problems, and if you just read my book, then you'll close all the deals in the world. That's not true. I would be lying if I told you that. This just increases probability. And that's all we're out here trying to do, is to find that one good deal in the pile of not good deals, and this just helps increase that. And I know the market's tough right now. I'm out here every single day. Deals are tough, and there's not very much product, but that'll change. I've been through all these market cycles. It'll change, and with the people that are going to be ready, and the people with the right skill set that know how to analyze deals correctly, are going to be the ones that pick up deals when the market shifts.
Thank you.
Hi, Bill. Question for you. I read your
Sure.
book, and thanks for putting that out there. It's a great read.
Please.
So I was just curious, in terms of either the master lease option or seller financing, how do you go about finding an attorney that's kind of versed in these things, and how do you really vet whether or not what they're telling you is actually the case, or they're just kind of blowing hot air?
Yeah, that's a great question. Yeah, that's a bit tough. You would want to find one. I would try and get a referral. So I always try and get a referral to an attorney. So probably start with like your local groups like this, where you're networking. Just kind of ask around if anybody has an attorney that's done any sort of lease option work. When you're talking to an attorney, ask them how many of these contracts they've completed in the past. So don't be afraid to ask them. What you don't want to ask an attorney is, hey, do you know how to do this? Because their answer is going to be, of course I know how to do that. Of course. Yeah, I do it all the time. That you can't ask that question. You have to ask them, how many of these documents have you completed? So it's a very straightforward question. And so unless they lie to you, that should let you know whether they are or are not skilled. But if you just ask them, do they know how? They're going to tell you yes. So be careful what you ask.
Thanks.
Sure.
So I do have a question for you, Bill. I've actually threw out a few offers using creative financing not too long ago. One of the things I'm curious about is, why would a seller want to, take short-term money now on a, let's say, seller financing, opposed to a lump sum of money that they can easily get, put it on the market or a cash offer?
Yeah, they wouldn't. They wouldn't. If they can easily get a cash offer, that's what they're going to do. I'm discussing deals that they cannot easily get a cash offer on because they either owe too much, they're over leveraged, the asset is deferred, got deferred maintenance for some reason. But you're right, and that's my point. If someone can just take that property, it's cash flowing, it's making money, it's a good asset, it's all nice and shiny, and park it on the market and make a ton of profit, that's exactly what they're going to do. And so that's not a deal that I would say is a fit for creative financing. So you may be misanalyzing the deals to begin with, and that you may be looking at deals that the deal itself was not a great fit for creative financing, and then therefore didn't get the offer accepted. That's not really a function of creative financing. That may be a function of deal analysis. That I would say perhaps, you and I should sit down and look at some of these deals and say, okay, what did you see? What made you think that this would be a seller financing or lease option? Because remember, again, if the offer only solves your problems, it's only good for you, the chances that the seller are going to accept it are low. Not zero, but low. And so this is not is it possible or impossible? Everything's possible. It's just, what is the probability that this will occur? And so if a seller is not in distress in some manner, low probability. I'm being honest. And that's why I kind of say you really can't go around just strictly looking for lease option, seller financing, creative financing deals. You have to go out and get the deal flow going every week. And that's what I teach all my students is it's not one technique that makes a real difference. It's not. It's consistency. You guys, everybody here needs to be analyzing 3 to 5 deals every single week, whether it's houses, whether it's hotels or storage or apartments, or whatever you're trying to buy. It doesn't matter. You need to be, it doesn't matter what size it is. You need to be analyzing 3 to 5 deals every week. And if you're doing that, then you're running your business. If you're not doing that, then creative financing isn't really going to help you because you have a deal flow problem and you need to be actually analyzing more deals. So that's the real truth there.
Gotcha. Does anyone else have any other questions for Bill?
Crickets.
If no one's going to ask, I'll just dominate the whole night.
I was like,
Do it. Hey, let's go for it.
Hey, Bill.
Yes, sir.
It sounds like that even in this market, if a property or an owner are distressed enough, then you still get these deals done. So
Absolutely.
My question to you is, what has been your best source of deal flow for distressed properties that you have actually gotten under contract using creative financing?
Realtors.
Even in the multifamily space?
Only in the multifamily space. Absolutely in the multifamily space. Yeah. Strictly talking, you're asking me where's the major source of my deal flow for creative financing? Realtors, always realtors. Now, is there some value going direct to owner? Yes. So what I kind of tell people in today's world, I think if you're trying to go for 50 units and under, so the average person is usually looking for 10, 20, 30, 40 units, something like that. I really think their direct to owner is your best bet, that you should be trying to reach out to owners directly if you're going under 50 units. If you're going 50 units and above, you really start to get into the commercial realtor world there. And I always kind of make the joke like, hey, have you ever seen a 200 unit apartment complex, with for sale by owner scribbled on the back of a cardboard sign and stuck out by the road on 200 unit property? No, come on. Nobody's expecting to sell 200 units on Craigslist or the classified ads or something like that. You know what I mean? So when you're talking commercial real estate, that's very much a commercial realtor's world. And so I'm kind of drawing the line around 50 units and up. 50 units and under, I think your best bet is direct contact. That can be cold calling or sending letters or lots of different, drop in voicemails. There's lots of different ways of reaching owners. But I would say if you're looking at smaller properties, you probably really want to be trying to go direct to an owner. Larger properties, it's realtors. Now, see, you asking me what's my main source, and it's mostly realtors because I largely do larger properties now. I started in houses in small multi, but I don't do them anymore. So mostly realtors for me.
So what might be very helpful is you talked about 2 different deals that you did using creative financing. I think it was 108 unit and then another one of similar size. when did you do those deals, or just pick one of them? When you did the
Yeah.
deal, how that deal came about, how it came to your attention, how you were able to determine that it was even a deal that might fit the creative financing, and how did you get the owner to open up and talk to you and consider that when he's got, because usually if there's a realtor involved, the realtor is
Yeah.
going to advise them against this type of financing, typically.
Yeah,
So,
they do and they don't. And so when you learn how to use these techniques, they don't. So first of all, you're right. A realtor is likely to be skeptical in the beginning. And the reason that a realtor is skeptical in the beginning is because they're concerned they're not going to get their commission. And so that's one of the first things you want to do is address that realtor's commission straight out of the gate and show them how they're going to get paid. I go through a lot of techniques for that in my book. But so anyway, a lot of, using realtors, you got to focus on getting their commission. But I'll go back to some of the deals that I didn't you ask about. So the 152 unit was from a realtor. And actually, I made an offer on that. They told me no, and somebody else tied it up. And it took almost 2 years later. They came back and said, hey, you still want that property. The other person that tied it up for that long failed. We closed that in 2010, actually. And I actually just sold it about 3 weeks ago. So we did 2 years seller financing on that, where we syndicated, brought in 20% down payment, and the seller carried back 80% seller financing on that particular deal. Just kind of a quick view of what we did there. The lease option was in 2011, if I remember. And that was, again, a realtor. Couldn't get the deal done, and the asset was distressed, financially distressed, not physically distressed. And I went in there and talked to them and said, if they would allow me to take over the property, I had a management company at the time. If they would allow me to take over the property, I could, get the operations straightened out. And that's when I suggested a lease option. So I kind of showed them. I didn't exactly show them how I was going to fix the property because I didn't want them to do it themselves. But I showed them that they were making some mistakes and that I knew how to fix those mistakes, and that if they would give me a chance of the property, I would take over and bring the value up and then exercise the option. So those are roughly how I got into those two different deals. But both of them were distressed assets. Both of them had some sort of financial distress. So the seller was motivated. Again, I know we haven't seen a lot of that over the last couple of years, but I promise you are about to see some of that over the next couple of years. And those are just some of the deals that I got into and some of the quick ways I got into those. But again, it's finding a motivated seller. That's the real answer. Finding somebody that just wants to do a deal.
So who typically controls the terms and when you're structuring those deals? Do you go about the sense of your price, my terms, or my term, my price?
Good question. So what I always tell people is give on price, take on terms. All right. So for seller financing, and that's what I have found is that sellers tend to be a lot more sensitive to the overall price and less sensitive to the terms. But it is really the terms that make the deal go around, that allow for cash flow and allow for us to do things like that. So it's give on price, take on terms. And if you'll do that, then as long as you get the right terms, and remember, terms also means time frame. So as long as you get enough time, then you have the time to go in and fix the property, turn the operations around, get the thing going, and the tide will float the boat. So it's really about time. Time is of utmost importance when using creative financing. So yeah, take on those terms and negotiate hard that way and give on price.
Awesome.
So Bill, we're talking about owners that are distressed or properties that are distressed. So there's different types of distress. You can walk your neighborhood and see an apartment building that's really in trouble. And I don't care what part of the cycle you're in, that's an owner that's in trouble. And you can approach that kind of owner in multifamily. But if you also think about where we are in the market cycle, it is difficult to find a good deal in a typical multifamily deal. But there are parts of the market that we all realize are stressed, and that we might have opportunity. So as an example, hotels have suffered greatly during COVID, and you might find some smaller hotels that are owned by an individual, particularly if it doesn't sport a name tag of one of the big names that you would recognize, where they have some contracts. But even there's opportunity. And I think that would be a potential place to look. Retail, same thing. A small retail strip center or an individual retail store that someone is running and you know they're in trouble or it's boarded up now. Any building in town that looks like a commercial building that's boarded up, find out who owns it, make them an offer. It can't possibly hurt. And just about anything can be repurposed into to something else that you want. And so if you're a multifamily investor and you want to own apartment buildings, try to find something that's in that other space that, a hotel would be ideal, but a larger retail like an old Kmart might work perfectly, especially if it's been sitting there empty for years. And even an old hospital or an old school facility would be ideal for turning into a co-living space, which before COVID hit, co-living was one of the really hot ideas. If you think about WeWork and some of those other spaces. So you just got to think outside the box a little bit.
Yeah, those are great points too. You're right, because creative financing, again, is not about houses, it's not about apartments, it's not about storage, it's about real estate. Doesn't matter what kind. And that's a great point. If the seller has a problem, you might have an opportunity. Doesn't matter what kind of real estate it is. Don't get in your mind you got to do apartments or you got to do houses, or you got to do this. Great point.
Awesome.
Hey, Bill, this is from Gallo. Do you mind if I ask you a question?
Please.
Great. First of all, thank you for coming on, man. This is really good stuff, especially
absolutely
good information as the next couple of years is going to start rolling by. So my question to you is, I wanted to find out if you can give me an example of maybe switching to the smaller commercial side, maybe 5 to 15 units, and give me an example of something you've done in that space that that you've used this technique for.
Oh yeah, absolutely. I mean, all of those work. I've done, 9 units, seller financing. I've given lease options on smaller properties. Yeah, so again, it doesn't matter what size and it doesn't matter what type of real estate. It's about finding a seller that has a problem. So what I would recommend, if you're looking at, say, under 20 units, probate court. I actually have a friend of mine that goes through a lot of the probate court material and looks for individuals that have inherited real estate through probate. And in a lot of times that is a seller that just wants a cash offer or wants some kind of revenue or wants something like that. And a lot of times they have a lot of equity in those deals because it's an inheritance. So if you're under 20 units or so, I might start trying to look through probate, things like that. Find someone that's inherited something. Find someone that, just for whatever reason, doesn't want the real estate. That's what I would do in those deals. But yeah, again, it doesn't really matter what size, 4 units, 10 units, 15 units. It's about deal flow. It's about talking to those sellers, finding out what motivates the seller. Why do they want to sell it? Why do they want to get away from it? And can you create an offer that gets you access to the property with as little money as possible? I'm not saying no money down because I don't believe in that, but as little money as possible is what you're after.
Thank you very much. And one follow-up question. I know you don't have a crystal ball in front of you, but can you give a quick estimate of what you see coming in the next couple of years regarding real estate and all that?
Yep. Several things. I think interest rates are going to go up, not way up, but I think interest rates are going to go up. I think that the fundamentals are starting to get compressed. And so what I think we're going to see is a cooling off window, not a crash, but a leveling off where people are going to have to become operators for a little while. Everybody's been able to kind of flip and quick money over the last 5 years. I think we're going to go into more of an operator window where people are going to have to be a little more of a landlord. You're going to have to kind of go in there and actually implement the value add, not just talk about the value add, but actually do it and actually raise the rents and actually be a landlord. And that's where I think it's going to create a lot of opportunity for people going forward. There's a lot of people that have gone out there and gotten very short-term loans, expecting the rent to just, continue to go up at 20% a year for the next 3 years or something silly like that. And if they don't have a perfect exit strategy, I think we're going to see a lot of motivated sellers in the market over the next 1 to 3 years. And those motivated sellers are going to be a sweet spot for creative financing. That's kind of what I believe over the next couple of years, but interest rates are going to go up and things are going to cool off a little bit. Not a major crash, but, cooling off. That's my opinion.
Thank you very much, sir.
Sure.
Awesome. Does anyone else have any further questions for Bill?
Yes, this is Brock. Bill, thanks for your time.
Sure.
Can you give us some examples of some challenges that you've had maybe doing the creative seller financing or leases, or like getting it set up, or challenges maybe as it goes through, as you're working through it, like that you may have come up with?
Absolutely. Yeah. Challenges, and people have kind of hinted around at them. Number one, market. When the market is too hot, sellers don't have problems. And when sellers don't have problems, that can be challenging for getting these kinds of deals done. Realtors can be challenging because in a lot of cases, they may not understand the structure, and it's kind of like the confused mind says no. So realtors and sellers not understanding the value is probably one of the big obstacles. So you're going to need to really understand how a lease option works, how seller financing works, so that you can explain it to a realtor or to a seller and explain it in a way that makes them realize the value in it. Then you're getting deals done. If you can't explain it to where they understand the value, a confused mind is likely to just say no, and they're just going to shut down on you. So those are probably some of your biggest obstacles. But it really, those are almost personal issues. I've never seen somebody get knocked out of this business because of a market. The market's up, the market's down, deals are good, deals are bad. I've never seen anybody get beat out of the business for anything other than the 6 inches between their ears. The only real estate deal you really have to close. And if you can close that deal, all the rest of them really don't matter, honestly.
Thanks.
Sure.
Awesome. So, Bill, another question for you. I know you, in your bio, you depicted that you also are into the property management business. So how can one start that aspect and sort of tie it into managing, your creative financing deals?
Yeah, I'm not. Property management, let's be clear about property management. That is not free money. That is W-2. Property management is that's a lot, Property management's a whole separate business. It's great. It is a separate source of revenue and cash flow, and it's awesome, but it will slow your growth because it's an opportunity cost. So please don't ever think that property management is just free money you're going to go get into. It's a hard work. But if it's a route that you want to go into, I think it is a good route, and that you want to start small. You want to start managing stuff when you have just a few units, because you're going to need to learn to build your systems. And if you can learn property management, it will definitely help creative financing, because it helped me in a lot of my deals, because I was able to go to a seller and say, hey, give me a lease option, give me seller financing, because look at my management resume. See, we have the ability to come in and actually turn your property around. And it was a way for me to bring credibility where a seller may have otherwise been suspicious about doing these deals. But don't let that be a reason not to go out and try and do these deals just because you don't have a management company. Honestly, I started doing the deals, and once I got some of these deals going, that's when I started the management company. So I did not start the management company and then go do real estate. I was out flipping houses and renovating, and I had multifamily and all that stuff. And then I finally started the management company. I was probably 4 years into my business before I started. I had almost 100 units before I started the property management company. So don't think that's some kind of prerequisite to getting started. It is not.
Understood. Jay Miller, I'm not sure if you want to unmute yourself and ask your question. All right. So I know Jay asked in the chat, what does closing on commercial properties look like this December?
What do the let's see. Oh yeah, look at that. What does closing on commercial properties look like December? Try and avoid that at all costs. Yeah. So closing. So as you move towards the end of the year, it gets tougher and tougher to close on a commercial property. Banks are trying to get all the properties closed that were already on their books. Everything is a mad dash. People are taking time off. So, if you have a property under contract and you have your loan application in, you're probably all right. If you're at the moment talking to someone looking to put a property under contract, I would probably try and avoid having a closing that involves debt in December if you can absolutely help it. Because lenders are a pain in the ass in December, just being honest. And nobody feels like doing new business. So they're trying to hurry up and get done all the old business. So I would really probably try and start over and close in January or February, where you'll have a lot less competition for the lender's attention. That would be my opinion. If that's the question you're asking. I hope that was the question you're asking.
Well, it helps a lot with regard to the banks. And I was curious if when there are private lenders involved, there's a lot of gray areas now with people calling themselves private lenders or agencies or websites saying they represent private lenders when they're really not. And I might be dealing with individuals. It just depends. But I had not closed a commercial property in December before, so I really appreciate the input.
Yeah. Again, private lenders and things can be very different. I'm really kind of talking more your traditional standard lender. And I'll tell you, to that point, you're right. Be careful these days. There are a lot of people trying to broker loans from people that are trying to broker loans from wholesalers to, and it's all of a sudden this daisy chain of people trying to hustle. So be very careful that you're talking directly to a loan originator, not some sort of agent or loan broker that you're not familiar with. Be very careful with that. And when you're talking to a lender, I recommend everybody kind of vet the lender a little bit. Just because someone says they're a lender or they're a bank or they're someone like that does not make them credible. So don't hesitate to ask them several questions. Number one, where do their funds come from, and do they have possession of their funds right now? So if it's a private lender, that's a very legitimate question. If it's Bank of America, okay, maybe not. But if this is a private or a hard money lender, you want to make sure they have possession of those funds right now. I have seen some people get under contract and go with a lender, and the lender actually went out and tried to crowdsource their loan and couldn't raise the money, and then didn't have the money there to actually lend them at closing, and that person had earnest money at risk. So if you're talking to a private lender, make sure they have the funds available right now. And then the next question would be, who is involved in the decision-making process? That's another very important question, because you want to make sure that you're talking to someone or someone close to the decision-making process. If you have to go through the broker, and the broker has to take it to the lender, and the lender has to take it to committee, and the committee has to go to the board, and so forth and so on, that's a loan that you might wind up getting some retrade on. So don't be hesitant to ask them where their funds come from. Do they have possession of the funds now? And what is the decision-making process to qualify for a loan? So those are the three biggies that I would say really ask, especially if you don't know who this lender is.
Awesome. We're going to take a few, about 2 to 3 more questions as we are coming to the top of the hour. If anyone else has any inquiries.
Yeah, I would. I was just thinking about identifying what Bill was saying earlier about identifying the type of property. If you think about a property that can qualify for a typical bank loan, disqualify it for, well, I'm not going to say disqualify. It's unlikely in this environment that that's going to be a seller finance deal. You can always make him an offer. If he's asking 800 and you want to offer him $1 million, then maybe you'll get his attention. Same thing with agency debt. If it qualifies, it's going to be very difficult for you to get him. If it qualifies for bridge, that's typically a little more likely that you might be able to get someone. But the only way you can get the deal done is with hard money lending, that might be a clue that you have a good opportunity, because even a seller that might not be willing to accept owner financing typically, if you dangle 10%, 11%, 12% in front of him, a lot of people are by nature, I think all of us have a little bit of greed in us. So I'd like to get your feedback on that, Bill.
Yeah, absolutely. I couldn't agree with you more. I like the way you put that. You know, if it's likely to quickly qualify for a bridge loan or traditional financing, it's not a great qualifier for creative financing. It's not. So I couldn't have said that better myself. Yeah, when you see those deals that for some reason doesn't quite fit the normal loan parameters, that's not your problem. That's all buyers' problem. And when it's all buyers' problem, it's a great problem to have, because then you can go in and say, hey, love you, mean it. I'd love to buy your real estate, but this evil bank over here, you can do the old good cop, bad cop, blame it on the bank, can't get a loan because your property doesn't qualify. Therefore, creative financing. So yeah, absolutely. I think that's exactly the way to do it.
Awesome.
Hey, Bill, I wanted to ask, could you elaborate a little bit more on the actual lease options? I have done seller finance before, but to be completely honest with you, this is the first time I've ever heard of doing a lease option for multi-unit.
Yeah, it is the same thing as a rent to own or a lease option for single family. We just call it master lease option. Over when you're talking about multifamily, it's the same thing. So again, it's a subject that would take a little while to cover in detail. I do cover it completely in my book, Creative Cash. Quick pitch. You can go on Amazon and get Creative Cash. As a matter of fact, I've just written a second book called Real Estate Raw, and I'll post it. I've got a website. I'll post that in the chat. But so yeah, a master lease option again is a rent to own scenario. So it's two completely separate documents. One document allows me to rent the property, and by renting the property, that allows me to control the management, the cash flow, and the operations. All right, so that's our rental agreement, the lease. The option to purchase is a separate contract where we set a price, and we fix the price today, and we have it, and you, the buyer, or me, the buyer, whomever, has a certain amount of time in which to buy the property for the pre-negotiated price. So it's two contracts. One lets me rent the property. One lets me buy the property someday in the future for a price we set today. The idea is with the rental contract, I go in and make the property run better, make it worth more, fix it up, whatever the case, right? And get it going. That's kind of what a real lease option is for.
So Bill, kind of wrapping up, on the properties that you own, number one, have you sold any of them using creative financing? Number two, would you be willing to sell more of them that way? Number three, anyone that has a property and is willing to entertain seller financing, the GOB network will, I won't make it an open checkbook, but it'll be pretty darn close to being an open checkbook to do deals with you. Because we have a lot of newer investors that are struggling to find deals. If you want a little bit more for your property and you're willing to get into a second lien position, then we absolutely can help you not only move any smaller properties, particularly because I like newer investors to start small and grow exponentially, then we'd very much be interested in talking to you. But since I asked the question, I'll put it to Bill first, if he has, and if he will.
Yeah, I have. Yep, mostly seller financing, things like that. I've done one lease option where I had an older duplex, and I actually did a lease option with a church that wanted to use it and use it for battered women's shelter. So I was sort of donated more or less through a lease option to the church and got some great tax write-offs on a property I didn't really want anyway. And they went in and renovated it for me so that they could put these women in there. And it was a property I wasn't going to renovate anyway. So I got the property renovated for free, and was a good cause, and certainly helped out some people. So I've done some of that, a little bit of seller financing. And yes, I would absolutely consider doing that going forward. depending on the deal, depending on the borrower, like anything else, you know, the right motivation, absolutely, definitely would do it. Yeah. You'd be surprised how much of this actually goes on in the commercial world. You know, it's like at this level, when you get up into the higher level, people understand this is how business is done and this is how things get done. It's actually not as difficult to pull off as you might think. It's when you're dealing with the homeowner and the grandkids grew up in the backyard and the memories, and then you have a realtor who just graduated realty school last week and they don't really understand the scenario. That's where it's not doesn't work so well. When you start dealing with professional owners, multifamily owners, commercial owners, it's like they get it. And I think there's a lot more creativity in that market than in the low, small single family and small multifamily market. Just because and I don't mean this to be a rude comment in any way, but you are typically dealing with a higher sophisticated seller of commercial real estate. They're more business oriented. And I think it's a little more understood. This is how that stuff gets done. Again, it's in the single family, small multifamily when you're dealing with someone that doesn't quite grasp these concepts. That's where it can be a lot more difficult, my opinion.
Yeah, I think I would agree with you overall on that statement. And I'll also say if there's any realtors on the call tonight, typically we have a couple or three. That's if you don't believe in owner financing, if you don't thoroughly understand owner financing, and you're in the single family space or in the small multifamily space, it's something that can give you a really, really awesome competitive advantage. So you need to learn as much about it as you can. Get Bill's book, get both his books. And I just really want to say how much I appreciate you coming on, talking
Absolutely,
to us.
my pleasure.
This is a
Sure.
space where we usually don't cover this topic that much. And glad to hear that you've been moving in that space, and really look forward
Absolutely.
to hoping that there's more of it to come here in the near future. And Mark,
there is. Yeah, and the website, I think just real quick, and I'll leave it at that. I threw in, the book is Creative Cash on Amazon. The second book, which is just now launched, is Real Estate Raw. And I have a website called Real Estate Raw. I posted that in the chat. If you guys are looking to get started in multifamily commercial, or you want a master class on how to use creative financing, go to realestateraw.com. I've got a lot of information on there. Sign up for the free class, and I'll have a lot more information coming out. So that's where you want to go, is realestateraw.com.
Awesome. Mark, I've got to run. Thank you so much. This is a great meetup, and really encourage everyone to come back every Monday. Mark is putting together some fantastic guests. So
Thank you, Jim. I appreciate it. And with that said, I want to thank everyone. I also want to thank you, Bill, for, of course, taking the time out to jump on and educate us on this amazing strategy, something that I'm very interested in as well. Again, for all those who will be watching this replay, all the information will be there in the chat. I'll try to put it in the show notes as well, and as well as the free masterclass that Bill is doing on his creative financing. So with
the Real Estate Raw in there.
Yeah, so awesome. So with that said, let's just get our screenshot together. So if you guys can jump off, turn on your cameras, let's just get a quick screenshot. Nice smiles, and then we can end this beautiful recording.
Yeah, there we go.
Awesome. Deetra, I'll definitely send it over to you in a second. All right, 3, 2, 1. Awesome. All right, Bill, thank you so much, sir. I don't want to hold you up.
Pleasure. So absolutely. Yeah, no, my pleasure. I hope everybody out there can go out and find some good deals.
Awesome.
Yeah, thanks. Thanks, Mark.
Have a good night.
All right, guys. Take care.
Take care.